and requires using our tools forcefully.
What are these tools that he's speaking of forcibly using to reduce inflation? Well, we're about to hear about it on Wednesday, September 21st. Jerome Powell is going to speak again what he's going to do to combat inflation. There's three main tools the Federal Reserve uses to reduce inflation. So we're going to cover those briefly. One is interest rates. Very simply, you already know this. Interest rates go up, it drives down demand, makes things more expensive for businesses to borrow. Number two would be increasing the requirement that banks have to hold in the Federal Reserve Bank. So traditionally, if a bank lends out $100,000, they need to hold $10,000 in the Federal Reserve Bank. They can't lend that $10,000 out to anybody else, and the banks don't print money. So they have a finite amount that they can put out in the economy. Now, during COVID, that amount of $10,000, or that 10%, was done away with. They could lend out the entire amount of money that they had on their books. So this put more money into the economy and helped the economy when it needed it. But if they change that requirement now up, it's going to pull money out of the economy rather quickly, and then of course shorten the amount of money on supply. And usually it impacts your interest rates. It increases the amount the banks charge you to lend money because money is more valuable to them now. The third piece is quantitative tightening. Now, to understand quantitative tightening, you need to understand quantitative easing. And quantitative easing was done during COVID as well, where the Federal Reserve essentially printed money and then they bought loans or debt or bonds out of the market. And when they bought those bonds out of the market, now the banks all had this cash that's sitting on hand, and of course cash sitting on hand for a bank does no good, so they reinvest that back into the economy by competing with other banks who also had a lot of money and driving down that interest rate. So that put a ton of money into the economy when the economy needed it, but now all that money is circulating around and inflation is going up. So to fix that, what the Federal Reserve has already done is they've stopped the purchase of bonds that happened earlier this year. And since June, you see the Federal Reserve balance sheet is slowly going down because that debt is being paid off. That's why they don't call it printed money necessarily, because it came in the form of debt and it will be paid off out of the system. So as that's being paid off, it goes there. If they wanted to accelerate that further, the Federal Reserve may do is just sell that debt back into the economy. And by doing so, they'll pull that money out quickly. That's quantitative tightening. That can be a little tricky and is really an uncharted territory to be done successfully without tanking an economy.